Hello, everyone. Today we're going to talk about what's going on with my portfolio. I know it's been a bit of bit of a while. I do apologize for that. I've been a little bit busy, or actually pretty busy with work recently, and then also took a recent vacation, which was nice and relaxing. But now back to it. There's been a lot of exciting movement recently with respect to the market. We've seen all-time highs. I think right now S&P is at like 550, so or 555-ish. So it's at another all-time high. This keeps continuing, and it's not kind of outrageous to think that it could keep going to 600, 650, or so forth. Actually, if we take a look at it, let's just talk about the general market really quickly first, and then after we'll transition back into the portfolio. So if we take a look at it for the past year, we could see that it previously had a peak of around 470. Actually, let's look at it at a 5-year. Yep. So we could see it's like a year. Yeah. Only 5 years, probably 5 years. There we go. So if we look at its previous peak, most recent or past previous peak was 470-ish, right? So if we take a look at our candles and we transition this to our candles, we'll see it's at around 470. Right now it only shows 456 because it's at a 5-year perspective, so it's a little zoomed out. But that was the previous peak. Then afterwards, towards October, we had a bit of a dip, quite a significant pullback, and that's when all the stocks were pretty much down. And then since then, we've been continuing to, continuing to go up this whole year, trending upwards. Very slight correction. I wouldn't even really call this a correction from 520 to 500. It's almost a blip. Really, really not much of a correction, to be honest. So it's just been continuing upward, 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 up until its more recent 555-ish all-time highs. Now that said, like I said, so relative to its previous peak, we could kind of look at the COVID patterns or pre-pandemic patterns to after COVID. So after we kind of assimilated to COVID, what that difference looks like, we could see it was something along the lines of like 350-ish, and then it went all the way up to like I don't know, 470-ish. And so that just goes to show what's that difference, or what's that delta. 120, which is roughly 1/3 of the value. If this were to hold, if that pattern were to be consistent, so 1/3 of the value here at 475-ish is what? 133 plus 25, 150-ish. Sorry about that. So if you add 150 to 470, what could we expect? We could expect up to 620. So that's why I say that it's not unrealistic to consider that this will keep going. Lots of people have been burned, even at the $500 range, kind of buying puts at that level or shorting the S&P, more so buying puts and just kind of getting bleeded out. There will be a correction at some point, just because stocks don't always just go up. Right, the overall market doesn't always just go up. While earnings for some companies have been pretty good, other earnings have decreased. We look at Starbucks, we look at kind of like a whole slew of companies where earnings have decreased. Victoria's Secret, I guess, different companies where earnings have decreased, and as such, Hershey's, there we go. Hershey's, its earnings have decreased, McDonald's, and so forth. Took me a second to think of some. But because of that, the EPS as well has decreased, and their PEs have kind of risen, and so that's why right now the market is technically not like all frothy, but it's pretty high. Like if we take a look at like historical PE values, right now it's a little bit higher. Now some of that is within like the Mag 7, but it's just kind of a scary time to buy, just because as investors, we should tend to do the opposite of what's going on. If things are going well and we want to consider maybe selling or closing our positions, if things are going poorly, we want to consider buying, and that's how we kind of optimize our returns, generally speaking. Now, going back to what I'm doing for my portfolio. So previously, I'm not sure where I had left off, but I want to mention the two big plays that I've recently made. So one of them was a purchase in Riot. So I believe this happened last week or the week prior. So my purchase with Riot was when the stock had fallen to $9. So at this point, the price of Bitcoin was still roughly 60K. So I thought it was still a really, really good price. So what I went ahead and did was I purchased 8,000 shares at $9 a piece. And then I went ahead and sold contracts on that. So I did that on June 28th, right? So I did that about a week ago. Yeah, last week. Okay. Yeah, this is just recent, so I don't know how I'm forgetting this. On the 28th, I went ahead and made this. I sold whatever stock I had at the time. I think it was SOFI, or I want to say, don't hold me to it. We'll take a look at that in a moment. But on Friday, I went ahead and purchased 8,000 shares of a Riot, and I sold contracts on it such that within the next 2 weeks, so you could see 7/12 on what would have been next week, next Friday, I would have received a total of 52 cents per contract. So we do the math, 52 cents, 52 times the 80 contracts, roughly a little over 4 grand. So 4 grand I would have gotten as a total back. However, what ended up happening this Monday? What ended up happening this Monday is from Friday, the stock hit like $9, and then it jumped up on Monday dramatically. And I ended up selling out when the stock had came back up. And let's take a look at what that was. So on June 1st, I was looking at different transactions. June 1st. Let's take a look. Here it is. Okay, so here's pretty much the trend. I have so many transactions, I apologize. It takes me a while to sift through them. But anyways, what did I do? I went ahead and purchased back my contracts at about $1.02. So let's put that back in perspective. I would have gained 52 cents of premium, but I bought them back more expensive. I bought them back actually at $1.02. So I lost 50 cents. So I lost 50 cents, which was effectively another 4 grand, or 4 grand. So I bought them back $4,000 more expensive. Now you might ask, like, why would I do that? Well, it's because the stock price jumped up. And whenever you're selling covered calls, and whether it's covered calls or you're buying calls, they're both, in a sense, somewhat bullish positions. When I sold them, if the price of the stock goes up, especially if it shoots up, it just doesn't matter if it shoots up, but if it goes up, then the value of the contract goes up. So it becomes more expensive to buy it back, which is what you saw. That's why I lost the $4,000 in some sense, not total, but we'll see that. But the price of the stock itself obviously is going up. So if the price of the stock is going up, that means the price of the contract is also going up. Now here's the difference. For every 1 cent that the stock goes up, right, it doesn't necessarily mean that 1 cent of the contract goes up. Or actually, let's look at it another way. If for every $1 that the stock price goes up, some fraction of that dollar is going up in terms of the contract price. That's what's known as delta. And so the delta so that's why, like, if you have like a contract that's really out of the money, your stock price could go up $1, but the contract only goes up 20 cents, 30 cents, right? And that's if it's really out of the money. If you have an in the money call that you sold, then stock price might be going up 70 cents, 80 cents, right? It just depends on how deep in the money you sold it, and also what the expiration date is. So going back to this, I lost 4,000 by buying these back, right? You see, I bought back 30 contracts, I bought back 50 contracts at 50-cent loss, which is $4,000. But I was able to sell the shares at $9.83. But remember, I bought it at $9. So if I bought it at $9 and I sold it at $9.83, 83 cents, right? So that's not the pure profit, right? That's just the increase minus the 50-cent loss. In reality, how much did I get? I got 33 cents profit times my 80 contracts, right? I would have gotten a total of 52 cents, but I got 33 cents. So I secured in one day $2,600 of the profit. Now that's to say, if I waited until this Friday, then I would have locked in the full $4,000. But you have to think of it from a perspective of within one day, and it just varies from like kind of different. This just varies in terms of different investing strategies. Other people could say, well, of course, Riot's a good company. It's very likely that it would stay above $9, and it was kind of like a sure thing. So by this Friday, I would have secured the $4,000. I could have net lost the potential profit of another $1,300. Yeah, so that's definitely a valid opinion. The way I see it is in 2 weeks, right? 14 days, I could have secured $4,000, or given the movement of the stock price, I was able to secure within 1 day, or technically 3 days because it was after the weekend. So Friday, 3 days, I was able to secure over 50% of the worth of that contract because I secured 33 cents out of the 52. What proportion is that? I secured 63% of the value of that contract in a very small fraction of the time, right? 3 out of 14. What's that? Like 20%. So in 20% of the time, I was able to secure 63% of the value. That's, to me, sounds pretty good. It sounds like a higher ratio. So I went ahead and secured that. Then that's part of my investing strategy. It's not to say that it's correct, right? It's just different people's risk profiles, to different people's kind of cost benefit analysis, and this just happens to be how I view it. So like I said, even though I lost buying, or I had to pay more buying to buy back the contracts, I was able to sell the stock price at a higher value and so forth. And that's why I was able to get that little bit of profit. Now, that's not to say I'm back where I was. So if we take just look back at the previous year, we can see that actually maybe the last 3 months. It's like I'm lagging a little bit, so let me go ahead and refresh. Okay. So if we take a look at it, you can see that my high was roughly on June 12th when I was at, right now, that's another thing. Right now, my value will show I'm at, my high was at 48K. This was really more like 48.5K, but that's only because I recently deposited some more money into my account, 4.5 grand. And so that's why it looks like it's higher. It's not that I gained that much more. It's just, so I don't want you to think like I'm suddenly gaining a lot more money. It was because I deposited more as well. So like, so in reality here, I was at that 44K mark that from my prior videos. So from that 44K mark, I had dropped down to like 35K, but now we can put it in this perspective. So from 48 to like 40, and then now I'm back at like 46-ish. So part of that was the riot gains, but you can see that I haven't yet recaptured that amount. And that's fine, just because what's my next position? My next position is SOFI. So in SOFI, right now, you might already know that earnings come out towards the end of this month. So that's something that's very exciting. As you may know, whenever there's moments of high volatility, so that leads to increased implied volatility, or IV, making contracts much more expensive. And so as a result, it's more, how should I say, beneficial to sell covered calls, right? So it would behoove people to sell them if they feel that the price action is still going to be depressed, like if there's still going to be ongoing manipulation, and then that way, even if the price stays static or even is depressed, you could lower your cost basis and secure some kind of profit. So going back to this, what's my cost basis on SOFI for the 15,000 shares? We could see that it is, okay, so here we can see that the value is $6.54. Okay, so that's my cost basis. And then we can see that the value of the contracts, I sold 152 for now. Let's just consider it 150. I'll talk about what these other two plays are. These are poor man's covered calls. I'll probably do a different video on poor man covered calls just to talk about that strategy. Let's just focus on the 150 contracts. So for 150 of the contracts, the price that I sold it at was 50 cents, which should be average credit. Here we go. Average was 50 cents. It's off by like 0.0011 cent, right? So it's roughly 50 cents. So for the 150 contracts, I get 50 cents, right? And that's 7,500 bucks. So I don't want to do actually 50 cents. The reason being is because my cost basis, right? I'm selling it at 650, but I bought it at 654. So I'm actually losing 4 cents. So it's actually 46 cents. That's why in reality, it's more like 7,000. So roughly 7,000 would be my profit if SOFI were to stay above 650. And if not, if SOFI were to stay above 650, then my new cost basis would become 604. Instead of owning the shares at 654, I would own it at 604. And that's kind of the advantage of selling covered calls, that you're able to either secure the premium or you're able to lower your cost basis, right? Because I know that if, for example, the next month people see that SoFi is still suppressed, people are already very retail in general is very upset about, talk to people on forums or watch a whole slew of videos on YouTube about SoFi. You'll see that a lot of people are very frustrated with the stock because its price has just been continually declining. Right? It's not getting a lot of love despite all the wonderful metrics that it's been producing. And so you can see that for this past year, it's been nothing but painful for people who did own stock. You can see since it IPO'd, oh no, it didn't IPO, it actually went through a SPAC, went through a merger. Since then, it's done nothing but really gone down. There was a moment where it was like at 450, and it shot back up to like $10+. And then since then, like I said, it's been nothing but going down. But this just goes to show that a bit of a different discussion that stock price does not reflect the fair value of a company in the short term. It's only over the long term that it does reflect it. And that's because in the short term, you can manipulate it as much as you want, especially if it's a small company, right? This is only worth a few $1 billion, maybe like 6 billion. That can be manipulated pretty easily, whereas like large companies that have a higher market cap, they're much harder to manipulate. Plus, they tend to generally regress towards their mean or their fair value. But in this case, like you could see companies like this get played around with for months, maybe years. It just, you never know. But the biggest thing is if you're an investor and you have time, right? If you don't need the money, if you're looking to kind of play it, I don't want to say smartly because I feel like that's a judgment. If you are looking at the fundamentals and you see like, hey, this is pretty good, this is pretty solid, everything's going well in terms of execution, and you see that you believe it's an undervalued play, and if you purchase it, it can be seen as I don't know what's a good word to say it so that it doesn't sound like I'm kind of trying to advocate for that kind of style, just because there's different ways to make money. There's ways to make money where you're playing it logically. Let me go ahead and say logically. And there's ways where you can do it with like momentum. There's ways to do it where you can kind of play lottery tickets. I guess you can make money that way. It's just not my style of making money. But anyways, that's my position. I have 15,000 shares, which translates to 150 contracts. I went ahead and sold them for about 46 cents net premium, right? If I were to get exercised. And so that would be roughly 7K profit. So that's pretty nice. And one last thing that I wanted to address was actually a few more details I wanted to address. I tend to talk quite a bit, so if you're still on this, thank you so much for listening. I hope that you enjoy this. But a few more things I wanted to address was another reason why I love covered calls is time works for you. So for every day that this stays at its same value, there's theta decay. So we can take a look at it here. What's the theta decay? I should be able to see it. Is it not here? So we're going to go ahead and, no, this is the stock. What am I talking about? Let's go to the options real quick. So if we take a look at the calls, we could see that the theta decay is right here. It's roughly 1 cent. So the way you do this is you grab this number, multiply it by 100, and you get roughly 1, which means 1 cent. So this means for every 1 day that passes, every one trading day, I believe, it loses 1 cent of its value. 1 cent of its value for 150 contracts is $150. So every day that it stays the same, you're getting $150. Now that said, it'll increase more. The data decay will increase more, of course, as time goes on. And so the last, let's say, like right now, it's still a month away. So it's losing about a cent a day. Versus next week, it might be like a cent and a half. Versus like towards the very end, the last few days, it might be 3 cents a day, right? 4 cents a day, or so forth. The one caveat is because there's earnings, it's going to see a dramatic drop in volatility once earnings pass. Because once earnings pass, whatever dramatic price movement would have occurred, potential dramatic price movement would have occurred, such as like a drop in stock price, or a drop in stock price, or increase in stock price, that would have been that would have already happened, or even if it maintained. The uncertainty is gone, and so that means the contracts decrease in value, which is another reason why, you know, I know people like to play lottery tickets. I know like people like to buy calls, just to buy, buy calls to kind of risk it, right? It's just if you're going to do it during earnings, maybe do it before earnings. Otherwise, you're going to pay a lot more. And if things don't work out, right? Like, let's say if the price goes down, that's the worst case. But if prices stay the same, you're still going to lose a significant amount of value because that uncertainty is gone. The implied value went down. The price of the contract drops down. And that benefits people like me who sell the covered calls, but that drastically affects people who negatively who purchase covered calls, or who purchase just calls. So I don't want that to be you, if that is in fact you. I prefer to only be taking money from people who are hedging, like people who are shorting the stock, and then they're buying the calls as insurance effectively. That kind of gives me satisfaction in that case, but I don't want it to be people who are just kind of thinking that SoFi is going to dramatically increase price. And if it is, I hope it does. That way you gain money. But I just kind of don't recommend that strategy. I don't recommend any of this, actually. It's not financial advice. This is just what I'm doing in overall. But these are just a little bit of my thoughts. Anyways, so that was one thing I wanted to mention, data decay, which is really nice. And the other reason is, or the other comment I wanted to make was, there might be some questioning of why I'm choosing to sell these covered calls at $6.50 strike price instead of $7, especially since a lot of kind of YouTubers and people are talking about it potentially going up, right? People who do this technical analysis. I'll make a video about technical analysis because it gets a little bit under my skin. But people are saying like it might go up, and it's looking very positive for these earnings. Not sure that I agree, just because Noto already guided that this quarter is going to be a little weaker. So that's kind of why things went down a little bit, because last quarter they said, hey, this quarter's not going to be as great. But the thing is that I would rather, this goes back to my kind of my risk aversion, so my kind of risk profile. I prefer to, I'm a little bit risky in the sense that I'm leveraged, right? I'm a little bit risky in the sense that I am leveraged. So if you could notice how much I'm leveraged, if you just does decide to drop down, you'll notice that I'm currently borrowing, I think, like $45,000, maybe $50,000. Oh no, here $44,000 to buy, to essentially double my position. So instead of being able to sell 75 covered calls, I'm able to sell 150. So that's part of my risk profile where I am willing to be definitely a lot more risky. That said, I'm not as risky in the sense that because I'm leveraged, I would rather secure it with an at the money covered call. Not necessarily going in the money covered call, because I don't need that much security. I do think that things are generally bullish right now for SoFi, especially since it's such a low price. I don't mind, even if the stock price were to go down to $6. I don't think it'll hit that $5 range. If it does, it does, and I'll be able to sell some more calls. But I'm kind of optimistic that things will either go up maybe a little bit or stay the same, and that's why I like the 650. So even though like there's the potential to gain much more money if I were to sell $7 covered calls, because I would still get quite a significant amount of premium. I think those are like 30 cents instead of 50 cents. I I just prefer that extra secure 20 cents because I'm leveraged and because, like I said, that security, it just kind of gives me a little bit more assurance, gives me more comfort. But I do have that risk in terms of the leverage, and so I'm able to get back some of that gains by leveraging myself. If I could leverage myself more, I think I would, but I would probably then do it at $6 because then for the more risk that I place on my position, I would want to kind of offset that with some kind of safety, which would be in that case selling them in the money at $6 calls. So that's just a little bit about how I choose to play it. I hope that this is interesting to some people. Generally, it's not too interesting to people when I talk about it, especially my girlfriend. Not very interesting. So, so I'm hoping that you guys enjoy it. If you did enjoy this stock talk, let me know. This is just what I'm doing so far, and I'll probably just hold this position until expiration. So it's not going to be too exciting in terms of news and updates. The only reason I might do something a little different is the stock price dramatically decreases or dramatically increases. So if the stock price goes to $6 and I'm able to buy these back, right? These 650 calls back, I probably maybe would. But if the stock price were to increase before the move, maybe it goes up to $8, then I'd secure most of the profit. I'd go ahead and not wait until I wouldn't wait until earnings. I would go ahead and sell out and secure most of that profit. And I hope that is the case because I know a lot of people are hurting right now with SOFI, so that'd be kind of nice. But that's it. Thank you so much for watching. If you're interested in this content and doing more, feel free to like, share, and subscribe, and I'll continue making these videos. Like I said, I have a lot more ideas on things like technical analysis, which I'm not a big fan of. Thoughts on like AMC, GameStop, and so forth, just because while I think you can make money on those, it's not, in my mind, it's not a prudent investment, in my opinion. And I can share my thoughts on why that is. Don't get too mad at me, hopefully. And then just some other thoughts that I have on regards to stocks. So thank you so much for watching. I hope you have a wonderful night, and I will be seeing you soon.